Let's bring in Sam Stovall from CFRA. Sam, great to have you on the show. I mean, you called it at the beginning of the year. You said this was going to be a bullish year. Does it continue?
Yes, I think it does, Morgan. Good to talk to you again. And I like to point to history. Obviously, history is a great guide. It's never gospel, but it does give you an idea that if the market does fairly well in the first half, then you probably have a lot of portfolio managers who feel like they have to play catch up. And so what traditionally happens then is we end up with a good second half. And also, depending on how much the first half has risen, gives an idea of how well we'll do in the second half. On average, the market's up about 4% in the first half, whether it's up or down. It's up 5% if it's the first half is up. The second half is then up 6% if the first half was up more than 5%. And as we're seeing right now, with the S&P up more than 10% so far, if that carries through to the end of the first half, history says we could see an 8% gain in the second half.
Interesting. I wonder how granular you've gotten in terms of digging through history and looking at this pattern. Is it a situation where what's worked in the first half tends to work in the second half, or does rotation factor in here?
No, what tends to work in the first half does continue to work in the second half. I looked at the 11 sectors in the S&P and basically found that in the second half, if you had a positive first half, then by letting your winners ride, not only did the market go up on average about 78% of the time in that second half, but then the three best performing sectors at least equal that advance, but outperform the market about 60% of the time. So basically, you're equal to or better than the market 6 out of every 10 times. And so that could even be looked at from a sub-industry perspective. So digging down even a little bit deeper than the overall sector.
So, Sam, what's happening with the banks? What are you doing there? And particularly, what's your read on the regional banks? Are they going to consolidate?
Well, to carry over the thought, what we have found also is that the regional banks right now are among the worst performers. We're the third worst performer so far, down 29% so far this year. And history would then say things are probably not going to be much better in the second half. We still have some of the banks that we favor, but we're fairly cautious on the group right now, having at best a neutral weighting on the sub-industry. So I think what's been bouncing badly in the first half will likely to continue to bounce in the second half.
What do you see as wild cards or risks to this thesis this year? I mean, there's been a lot of talk about the Fed, and of course we saw Powell 2 times on the Hill this week testify that 2 more rate hikes are a likely guess. The word he used was guess. Does that change any of this if we see that come to fruition?
Yeah, well, I think, we've had times in the past in which we have had a double-digit first half gain only to then post a decline, fairly substantial decline in the second half. Once in the 1970s, 3 times in the 1980s. So, yeah, I guess the concern is that if the Fed continues to be overly hawkish and that we do see the array of indicators that are pointing to recession do finally kick in, and the recession is more than just mild, as what I think has already been factored into the market, then even though the S&P 500 has been confirmed in a bull market up 20% and has recovered 70% of the overall decline, and no other bear market advanced by that amount, only to then turn around and go even deeper. But history frequently is rewritten. So if the Fed is overly aggressive and throws us into a deeper than expected recession, yeah, I think you can throw these numbers out the window.